Good day. My name is David Brooks, a licensed finance professional. Today I'm going to be talking about why can't you fund an index universal life policy with one lump sum. So basically, TEFRA, TEFRA, and DEFRA, DEFRA, that's the IRS tax codes that dictates the minimum amount of insurance required based on age and gender to have your money accumulate tax-free and be able to access the money inside the policy tax-free. So the banks and brokerage firms were jealous back in between 1984 and 1987 and couldn't compete with, back then, with insurance companies. So they were pouting that people were taking money out of the banks and brokerage firms and putting it into max funded life insurance policies because they were safer. So they paid higher, the insurance companies paid higher interest, and they don't, and also they don't have near the risk, and they were tax free. And when the insured passes away, the policy blossoms and passes on to the family tax free. So all the banks and brokerage firms got together and lobbied Congress, and they seceded. And on June 21st, 1988, the Congress came out. They seceded. So the banks convinced Congress under the Technical Miscellaneous Revenue Act, TAMRA, TAMRA, of 1988. They convinced Congress to slow the flow of money from their institutions, which were inferior, and from going into the IULs, which were superior. So the bank and brokerage firms wanted to make sure that the money took 5 years to leave their institutions. So TAMRA said after June 21st, 1988, if you wanted to max fund an index universal life insurance contract, you'd have to spread the max funded amount over a 5-year period. And if it's a whole life policy, you'd have to spread it over a 7-year period. And that's a term they came out with called 7-pay. And so if you were, say, 60-year-old, you want to put $500,000 into $1 million index universal life policy, you only could put in $100,000 per year for 5 years, or 20% of the most you want to put into the policy. But now you have complied with TAMRA. And now forever after, the income you take out of the policy, say the $500,000 doubles to $1 million in 7 to 10 years. Well, that $1 million now is tax-free because you comply with TAMRA. So you only put in, let's say you only put in $10,000 your first year, which covers the cost of insurance. The other $90,000 rolls over to year 2, where if you say if you came into a windfall, you can put in $190,000 and still satisfy TAMRA. So if you want to use your policy just to leave a death benefit to your family, you don't have to worry about TAMRA and just pay the cost of insurance. But if you want to use your policy to generate income in retirement, don't put in more than TAMRA allows over those 5 years. That's the fastest you can fund your insurance policy. But if you put in too much into your policy, it turns into a MEC, MEC, which stands for Modified Endowment Contract. And if you go to access the money, it's going to be taxable now instead of tax-free. But you can unmec your policy and in a 60-day period by telling the insurance company that you made a mistake, and then they will refund you the money that you overpaid. Then after the new calendar year starts over, you can put in that extra money back into your policy without it turning to a MEC. And so if you want to learn more about how to generate tax-free income inside your life insurance policy, just message me IUL or book an appointment on my calendar. So that's my tip for the day, and you guys have a great day.